Hi everyone, this is Dimel Gonzalez of Heartwood Financial Services. Welcome to another market update. As you can see, we survived Hurricane Dorian. We were very fortunate here, not so much in the Bahamas and up in the Carolinas. So our thoughts and prayers definitely go out to them. We have a great update today, so stay tuned, watch the whole thing. It's going to go by fast. Okay, right off the bat, let's talk about performance. I'm showing you here the asset class returns for the month of August and also year to date. As you can see, most of the market was down a little bit for the month, but still we're doing really well for the year. A couple highlights is real estate. Real estate was up 4.87% for the month and up 28% and some change for the year. You'll be glad to know you do have some real estate in your portfolio. Another highlight has been the fixed income markets or bonds, the more conservative bonds. They were up 2.2% for the month, up 7 plus for the year. We'll talk a little bit more about that in some of the next slides. But you could also see high yield, surprisingly for some people, has been doing pretty well. Not as well last month. Up 1.95, but still up about 14% for the year. Overall, it was kind of a mixed month, down a little bit for the market, but holding up still pretty well for year to date. So year to date, we've been doing pretty well, but there have been some issues that have been slowing things down, and they've been showing up here in August. The first one, which is the one that's been going on here for a while now, are the trade tensions, and they have intensified. We just raised more tariffs on China, and they have retaliated. And there doesn't seem to be a near end to this, although I would say there is some political motivation, especially from Trump, to try to get something done. So I am cautiously optimistic there. There continue to be protests in Hong Kong that have hurt China economically, and also makes them a little harder for them to negotiate when they got issues in their own country to deal with. Brexit uncertainty continues. Boris Johnson is now trying to get a Brexit without any kind of deal, and Parliament is fighting him. They want a deal, and so this kind of goes back and forth. Unfortunately, this may not end for a while, and that's creating some uncertainty in the UK and in Europe overall. And of course, the last point is that data is starting to show that the global economies are starting to slow down, and they are starting to show up some here in the U.S. as well, but not to the same degree. So that is something to be concerned about, and we'll keep an eye on. And here's the most updated math of the market chart. Not much has changed. We still have same earnings estimates that are looking here for the rest of the year, for next year. So we have the same earnings per share growth at about 4%. The biggest change is the price of the stock market now. And I've introduced a new component which I call a PE multiplier. So basically I'm trying to take into account the fact that interest rates are super low, and that will allow the multiplier for the price to earnings ratio to be a little bit higher. And so when we look at the figures now, I show that the next 12 months that we'll be making somewhere around 4 to 4.5% if earnings continue at the same path. If they get better, it could be higher. If it gets worse, it could be lower. But for right now, we're still looking pretty good at about 4.5%. Here's the latest leading indicator chart. As you can see here, the red dot again is the average of all these leading indicators. And last month, the average was right around here, which means it's actually moved slightly more towards the expansion quadrant. There has been a few things that have gotten better, like existing home sales, manufacturing, or I should say non-manufacturing. Manufacturing has actually gotten a little bit worse. Consumer sentiment has also gotten a little bit worse. But there are several items that have gotten a little bit better. So the leading indicators still show that A recession is probably not imminent. In fact, things look pretty stable. But again, things, especially the yield curve, that continues to be in the slowing down area, cautious zone. And so I don't think we're completely out of the woods, but things look a little better than I think the media makes it out to be. So one question I get asked a lot is, what is going on with bonds? Why have they done so well this year? Well, first of all, I want to show you what happens to bonds when prices go up, okay? So it's a basic teeter-totter. It's a negative correlation. So when prices go up, the yield goes down, okay? And so what we've been seeing here with bonds is the prices have been going up while the performance has been good, and that's been bringing the yields down. Now, there's a couple of reasons why. One of them is what a lot of people are concerned about. The recession fears, global slowdown, all the wars that we're having economically with China and the tariffs. And so that has been pushing the prices of bonds up, yields down. Also, we have a lot of fiscal stimulus going on globally, especially over in Europe and in Japan. And what's been happening is, you can see on this chart to the right, this is the percentage of bonds that are investment grade quality in the world that have a positive yield, okay? And so the U.S. makes up about 88% of the positive yields in the world, okay? So it's pretty amazing. So what we're actually seeing right now is, because there's so many negative yields around the world, people are coming, foreigners are buying bonds here in the U.S. So again, pushing the price up, pushing the yield down even more. Some people think that, when we see this, a recession is coming. Now, that might be true, but it's being exacerbated by this yield drop because of the price going up from all the foreign buyers. Some people ask me, Dima, why are you so confident that we're not likely going into a recession here in the next year? And I'll say, well, I'm never completely confident, but other than the leading indicators that we were looking at, another thing that helps me a lot is the state of the consumer. Again, they are over 66% of the economy comes from consumption from everyday people like you and me. And as you can see here from this chart, this is debt as a percentage of GDP. And we still look pretty healthy. It got really high back in 07, 08, but you can see how we still have a lot of room to get back to where we were before, meaning that the consumer is a lot healthier. And that's very important. So here's my outlook for the next several months. As we can see from the leading indicators, things are slowing down, but the probability of recession still remain fairly low. Global growth continues to soften, and especially with these tariffs unresolved, it could continue. But I don't think we're going to see global slowdown to the point where we're all going to be in recession. There could be some that come up here and there, but I don't think it's going to be mass recession. Another thing is there's going to most likely be another Fed rate cut here in September. I know Trump wants a big rate cut. He's probably not going to get that, but the quarter point rate cut looks to be in the cards, and that will continue to support the stock market and probably still hold up bonds pretty well in that type of environment. And lastly, what we're doing is we're continuing on our neutral stance, not to get too aggressive, too conservative. Basically, I'm calling this the polarized market outcome potential. If tariffs get waived, market could be up a lot. If it continues, we can continue to slow down. So it's a lot of it has to do with how the tariff outcome will come about, which is completely unknown. So in the meantime, we're going to stick to our neutral stance for now. So my educational slide for the month is, what type of investor are you? This is a chart that goes back to 1977 to the end of last year, and it shows the blue being the opportunistic investor, which added $2,000 every time the market dropped by 8%. The orange is the apprehensive investor that took $2,000 out of the market and went to cash every time the market dropped 8%. And then the green is just a buy and hold investor. And as you can see by the chart, the blue, which is the opportunistic, makes a lot more money, over $1 million, versus the panicky or apprehensive investor that only makes $430,000 or so. You would have been better off just buying and holding, but more opportunistically, you probably would have done even better. So which kind of investor are you? Let me know. Hopefully I'll help you become more of the opportunistic investor. Thanks a lot, guys. I appreciate you guys listening in. I have one last little message until we meet again. What is your why? I listened to this podcast by Simon Sinek on one of those TED Talks, and I really enjoyed it. He wrote this book called Find Your Why, and I thought it was a really great thing to think about, not just personally, but also for your professional career. And a lot of times people ask you what you do, and what he proposes is that we should really be thinking about why we do it. That really shares more of a story behind what you do. And if you think about some of the best marketers out there, people that really tell their story, it's not about, what they do. Apple doesn't just make computers. They want to be more creative. They want to think out of the box. They want to change the world. And so I just wanted to encourage you to read his book, check out his TED Talk. Give me a call sometime. I'd be happy to share with you what is my why, and maybe you could practice on me. Thanks. Until we meet again.